Hey, what's up, everyone? Happy New Year, and welcome back to another Ask Me Anything happy hour with the BYOB Money Mentor team. We're excited to be here. It's a new year, new goals, new strategies. We're bringing you the best of the best this year. Looking forward to it. So now's your opportunity to get any questions you have in the chat box. We're going to go around the horn, introduce ourselves for the new year, and get to answering your questions. So with that being said, get the questions in, and we will be right back.
Maybe not.
Maybe not.
Told you. All right, so here we are. So
You did it.
my name's Stephen Nagy. I'll be here answering some questions with you guys this year. And let's see what's going on. What's going on right now? We got 2026 off to a hot start. Hopefully everyone had a good holiday season and a good time. Today the shows were fun. Did a little what the F and talking about everything crazy going on in the world. Wealth webinar was a lot of fun with Craig Yenny down there. Hope you guys enjoyed that. I did get one question from that to kick it off with today, so I'll ask that once we get to questions. But I'll pass it over to Brian Fouts.
Hey everybody, Brian Fouts here. So we had a white Christmas this year. It was kind of questionable. My kids were all bummed because it wasn't going to be white, but we did have one. Not very much.
Wait, you were in Miami too? Oh wait, never mind.
Yeah, exactly. Yeah, up here in North Idaho, we typically have about 3 feet of snow, and we have 6 inches right now. So it's really crazy. Warm this year, so I don't mind because I do not like the snow. So there we go. But yeah, having a lot of fun, doing a lot of calls, and I'll pass it over to Tess.
Hey, I'm Tess Hulick, and I actually followed all the guys today on W2F and Wealth Wednesday. Amazing. I love the chats. I love talking to you guys. Looking forward to 2026 because I believe we're going to reach a lot more people, and I'm excited to see how we end this year because it's going to be amazing. And now I'll go down to Linus.
Thanks. Hey, Linus Nolt here from Hopkinsville, Kentucky. Excited for the new year and lots of people to help. Plenty of people that I'm talking with about IBC and how they can implement it in their own life. Fun times. And as you can, so new year, new look.
And we lost you temporarily.
Yeah, you broke up.
Oh, I said, I'm not sure which part you might have missed, but I said, you might have noticed, I let Verna chop the beard off.
Oh, that's what it was.
Go for it, Joe. What's up?
All right. Well, the calendars are full, and Brianna's been making sure that I don't have a free moment. So keep the questions coming so I can help you and answer and strategize and get your questions in here so we can get everybody on the same page and help everybody's mindset. Over to Craig Adore.
Thank you, Joe. Craig Yenny here, and 2026 is going to be groundbreaking. We're really going to launch the vault. So if you don't know about the vault yet, you should check that out. But it's the big launch this year. We're going to be sponsoring the Nelson Nash and Institute think tank. And I just was thinking a lot about innovation recently, and I thought to myself, a couple innovations like the shovel, that was groundbreaking.
I knew it was going to be a joke.
Hold on, but the broom is sweeping the nation. Anyway, just want to leave you all with a nice dad joke to open up 2026. Down to Jason.
Well done, Craig. Well done, man. That was awesome. And hello, everybody. Back from South America. Happy to be back. We were down in Ecuador. We got to see how they celebrate New Year's, and I got to say, I want to go back. They burn stuff. They shoot fireworks over your head. They come down in your hair. There's music playing. Wow. It's a little nuts. Bushes look like they caught on fire, but it was all good. All good. And Craig, I thought the vault was already launched, so that's kind of news to me.
Well, we haven't not official. We've just been kind of rolling it out, but we haven't done a big splash yet. So we have some cool things coming.
Awesome. And we've got one more thing. Sorry, Tess, I'm excited about is, we got the vault for all the math. we're going to have our family GPS, the generational positioning system, for all of the thinking, for the values, the Constitution, what you stand for, against, and how to do all this stuff and pass it on. Because I don't know about a lot of you fathers that are here, and I worry about this stuff. Like, what happens if I do pass away? I do graduate unexpectedly. How does my family know what to do? Where is everything, and how do we carry that forward? So that's something I'm excited to share in the 3-day coming up. And so stick around to learn more about that. So,
And I was just going to say, you'll have to check the Facebook feed. There's some kind of cool ads going out there now about the vault. I just saw a couple today.
very awesome. The vault is a fit. How many members are already signed up, Craig? Aren't there over like 300 people already using it, or more than
600.
that?
600.
Wow.
Yeah.
Yeah, that's awesome.
It's going. So we want to get as many people as we can helped in there. So we're going to keep building and building. And gain projectors on the brink of being released. I've got a little more work to do on that, but it'll be out and ready to go.
Very cool. Very cool. Let's jump into this. We got some questions, or what does it look like, Phelps?
Yeah.
I got one to start with. Just before, if I could start with this one real fast, that somebody texted me just so I don't forget about it. So it said, this was in regards to something I was said on Wealth Webinar earlier. We were talking about $100,000 dump in and $20,000 a year thereafter, just as like kind of a cool example of a dump in policy for real estate investors. But you were asking, another investor and I, both in our 50s, don't like the $20,000 per year as we plan on retiring soon and don't want to have a $20,000 per year liability for an extended time. How can we get past that? Would taking policies on an adult child help, or dump on $20,000 for 5 years, or some variation?
Yeah, Snaggy, thanks for the question to start the year off. I think it's a great place to start. We don't have money problems. We have money patterns. And this question's coming from someone thinking just like an investor. They're literally thinking like an investor. They're not seeing the power, the guarantees, the control that is provided by using this as an and asset. If they're doing that big of a dump in without even doing the math like Joe can do, like I can't do that. But like if I could tell you that this is going to be a money tree or an efficient policy by year 2 or 3. The way it's designed. And that means every dollar going into this is going to give them more than $1. And that's going to keep getting better and better every year. So as long as they keep looking at this as a cost, they're probably not a good fit yet. Like they'll get there, but the real asset is there's going to be a couple years where they're not going to have full access to the capital going in. And then every year after that, every dollar they put in will give them more than $1 tax free to use. And that's going to keep getting bigger and bigger and bigger every year. And I see Craig wants to throw in some extra thoughts here. I can tell he's leaning forward. So Craig, what else you got to add?
I just lean forward because my back hurts all the time. So I just lean on my desk.
I'm sorry to hear that, bro.
No, it's good. It's all good. But yeah, I mean, it's really, we have to think of the policy in context of what you're trying to accomplish now and then what you're trying to accomplish later in the future. So I think sometimes people do get into that mindset of what happens when I get to retirement and I don't have money to fund the policy. But hopefully you do have money to fund the policy. Otherwise, you probably shouldn't be retiring. But the whole point that Jason was making is, as you're putting money into the policy, it's still growing, it's compounding. You still have access to that liquidity, and you're at that point you're getting more out than you're putting in. So the question is, are you going to have expenses, needs for financing when you're in retirement? Most likely you will. And there's a lot of really cool things you can do with retirement. I think it was earlier last year, Chris did that whole presentation on retirement strategies with the covered asset, the volatility buffer, how whole life can play a role in retirement. So I think sometimes we have to look at the bigger picture and see, how does this fit in later? So right now you may be using it for real estate investment. How does this whole life policy fit in guaranteed income structure when you're in retirement? Anyway, those are some of my thoughts.
If I were on a phone call with this person doing a strategy call, we would go over that illustration. I would show him or her how much is actually being left in the policy in year 1, and what is being able to be used. And then in year 2, I would show them that if it is a money tree in year 2 or even year 3, the fact that all of that deposit that they're putting in, they're able to take right back out. That is the meaning of the money tree. That means cash on cash in that year. And by putting that money through the policy, the money that we borrow, the PUA, and the PUA is what the dividends are being paid on. So why would you want to put less than 20 in if you're going to spend $20,000 to live anyway?
Yeah.
Pay yourself first before you use the money. That person is thinking with scarcity mindset, not abundance. So that's how I would handle that strategy call and answer that.
Love it, Joe. Love it, Craig. What if the person, like, say you get 10 years into and you are retired and you're like, wow, how am I going to get $20,000? And you tell your neighbors or people that are really in your circle, hey, I got this great investment. I'll give you a 20% return right away within a month. And then you get the $20,000 from them. You put the money in the policy. You have over 100% return, 10, 11 years into it. And now you're giving them the 20%. So you just made 80% with someone else's money. That's how you think like a banker.
Yep. In that 11th year, Jason, you're correct. You're between 200 to 300% cash on cash. So just by depositing that 20,000, you're going to be able to take out 50,000. Why would you want to put less than that in?
Are we super echoey for everyone?
They're echoey, yeah.
Okay. New year, same technology problem.
StreamYard feedback.
All right, we'll get into these questions here. All right. So Keith is asking this question. I'm ready to retire. No debt other than mortgage that has 5 years to pay to zero. No plans for major purchases. Give me ideas on how I can use infinite banking.
I wish I had some ideas.
Well, so Keith, honestly, the ideas should align with your goals. So the question I would ask you first is, well, what are you trying to accomplish? What are your goals? Because then you can start to look at what you can use infinite banking for. Because there's a multitude of things you can use it for. Buying a car, invest in real estate, go on a vacation, for college for your grandkids. But do any of those align with your goals of what you're trying to accomplish? So, anyone else?
This I bring back to any dollar that you take out of your pocket and hand to the cashier or hand to the waiter or hand to the car payment or hand to the mortgage. If you run it through the policy, you'll always make dividends on it until you stop breathing.
Yeah.
That's my basis that I always go back to explain to people with the mindset.
Cool. All right. Master Cook says, hello, everybody. I'm from Germany and plan to start with BYOB, Be Your Own Bank. What would be the first steps? I need advice from you if it's possible to achieve it. Are you willing to move to the United States or Canada? That would be the first step right there. Not really.
Well, on Chris Noggle, I think the title is pretty close to. That would be a good place to start. And
hey, your mic's cutting in and out, Linus. Something's wrong with your mic. I don't know if it's the connection. Maybe you're on the wrong. Sometimes straight to the wrong mic. And I don't know where it's coming from. Is that from Fouts? Let me see if I mute Fouts.
Is this mic better?
Yeah, Fouts, if I mute you, the feedback's gone. So you might need a new mic or something as well. I muted you.
Okay, now I'm unmuted. Has that changed anything?
I was just going around muting everyone to see where the feedback was, and it's definitely Fouts.
I actually mute mine manually outside of this.
Yeah. I just muted everyone to see, and I think it's you.
When I'm speaking, is
this mic better?
Yeah.
Okay, so what I was saying is that there's a good video on Chris Noggle's YouTube channel. I think it's titled something along the lines of practicing infinite banking outside the United States. So that'd be a good place to start to get some knowledge there. if you want to use a whole life policy for infinite banking, that's typically only going to be something you can get in the US or Canada. So if you do not have close ties to the US, like maybe property, bank account, business, or something in the US, then or Canada, then a policy might be out of the question for you currently.
Yep. Cool. Let's see here. All right. Carly asks, would like to build a shop, would cost approximately $150,000. We do not have that in policies yet, but do have that room in an all-in-one HELOC. Would it make sense to start a new policy with that amount as a dump in? Joe, you want to take that one?
There's a couple more pieces, like the rest of the questions, and a couple more comments there.
And then, yeah, and then borrow out of the policy, or is it double borrowing? Trying to figure out how money flows so our 150 grand isn't gone forever.
Is the shop going to make us money?
That's what I was going to say too, right there. So yeah, what's the purpose of the shop? First off,
Yeah.
because if
Well,
the shop
part of
is
it
providing
too-
cash flow, then
Yeah, part of it too, if it's not going to cash flow right away, how much time before you think it will cash flow, because you'll have nothing to backfill that all-in-one or the policy loans. We just need to look at what's that cost, and then once the shop starts cash flowing, then what's the picture look like? So there could be some risk in there that I don't know if I would personally want to do that, but we just have to run the math.
Yeah, because you definitely do have two debts you're creating. Then if you're not creating cash flow, you got two debts: the HELOC and the policy loan. If you're creating cash flow, though, then that runs through the HELOC back into the policy, and you got the circle. And so that would make a lot of sense. But I mean, it all depends on your cash flow too. I mean, it's a long term. If you're not creating cash flow through the shop, then it's a long term strategy to make sure that 150K is there for the long term. But you just got to make sure that your cash flow can support the HELOC, the policy loan, all that kind of stuff. So I definitely would want to run through the numbers on that one.
Utilizing the HELOC to build the shop and then use velocity on a monthly basis to recapture that if the shop isn't producing cash. You can utilize the money out of the policy and pay that back too. That's going to be a lesser rate than utilizing the HELOC. So if you were to utilize the money in the cash value of the policy and then use the leftover out of the HELOC, mathematically, that's probably going to be your best option if there is no cash flow.
Yep.
Because then you can recapture back into the HELOC, overfill the HELOC, and then refill back to the policy.
And then also, I would just add in there too, is just figure out what kind of war chest or how much emergency fund or opportunity fund you need setting aside. So I wouldn't take it all, but leave some through. So if you have some bad months or something goes south on you, you're not put in a bad position there. So leave some liquidity in there in that system too.
Yep. Cool. All right, so a quick question here by Master Cook says, which kind of plan can I have if I start with a finance of $2,000? So we need some more information.
I believe this is the same guy that was asking about infinite banking in Germany.
Oh, yeah.
Mhm.
So if you're looking at $2,000, I don't know if you're talking about funding a policy monthly with that amount. So kind of need more context to the question or what you're referring to.
Yeah, I'm not sure on that one. But typically, I mean, 2,000 like on an annual basis would typically not be adequate for most policies for an adult. So, all right, Christian's asking, how do you convert amortization interest to simple interest? Example, 45K for 60 months at 6.74% for payment of $886 per month.
6.74 is if this is amortized 60 months All right, so that's 5 years. 6.74 is equivalent to about 15%. So you would have to break it down that way. 45% or 45,000 minusing what your monthly cash flow is on a.
I mean, one thing that Christian I probably would check out is there's a website called dinkytown.net. So you can just go Google it. It's called Dinkytown. It's the funniest name. I don't know why they called it that, but it's hundreds of financial calculators, and you'll probably find something in there that can help you do that. I refer a lot of people to that website because it's just got so many calculators. I use it for infinite banking, by the way. So whenever I want to run a loan for infinite banking before the vault existed, of course, I'll just go there and run the calculation. It gives me a whole table of payments and stuff for schedules. So that might be a place to start.
This looks like a car loan. This looks like a car loan to me. 45,000 at 60 months at 6.74 for payments. And if you're saying, if I have a HELOC at 8% or 9% and pay for it out of the HELOC and then recapture and do velocity banking inside the HELOC at 8%, would that save you money? Yes, because you're paying 15 by doing it this way and 8 by doing it the other way per se.
And Christian, I think you've got a vault account. You can go ahead and put that 45,000 at 60 months. Just put the 45,000 payment in there at 886 for 6.74. Go into your velocity banking, configure your velocity banking and your HELOC in there, and just run it. It'll just show you the numbers. So that's how I would do it.
Yep. All right. Let's see. Bud has a good question here. I'm 68 years old and in reasonably good health, non-drinker, non-smoker. Give me an idea of how much it will cost me for a 1 million policy and how long before it has usable funds. Thanks in advance. So I'll just say one thing here, Bud. I think you're coming at this from the wrong angle, just to be honest. So with infinite banking, we typically are not building the policies for a specific death benefit. We're building it for what you're trying to accomplish and what you want to use it for. And that's usually on the deposit side, like how much you want to put in per month. But I'll just be honest here. For a 1 million policy, whole life insurance, permanent insurance at 68 years old is going to be very expensive. It's going to be a very high premium if you're talking about a permanent insurance. So anybody else want to chime in on that one? That's a good one, though.
No, it's just the typical view, right? It's how much can I get? If I put X amount in, how much coverage do I get? Where we're saying, okay, well, how much, Bud, how much do you earn? How much are you saving? Where are you storing your savings? What is your goal? What is your outcome? And then we can kind of direct you from there with a specially engineered policy. And then we'll find out what your death benefit's going to be, right? So,
yeah.
Just like Jason said, these are specially designed. These are built backwards. Yeah. These are built with the deposit and how much goes to the base and PUA, and then the computer kicks out what the death benefit is. We're not going in with the death benefit and giving you an amount per month. We're utilizing your income to create a banking policy, a credit union, your own credit union, Bud's credit union, if you will, to deposit money into. And then, yes, you will get a death benefit from that deposit. That's how our calculations would come out.
Yep. Another piece of the question I'll just quickly answer, where he says how long before it has usable funds. A policy that's designed for infinite banking is going to have immediate liquidity. So you'll be able to take a policy loan immediately. When we say immediately, we really mean within the first 30 days, typically quicker, but that's what we say to under promise and over deliver.
Yep. Cool. All right. Subaru says, I have been wondering if a person started a smaller policy for $6K per year with $12K of extra PUA. So we call that a dump-in, by the way, PUA room, depending on how you're breaking that out. If they started the policy, paid the annual premium, and maxed the PUA out every year, then borrowed out max loan for the year, then did the same thing for year after year without repaying the loan ever, would the policy survive if it was done like that? No, it wouldn't, by the way. then what if they just paid the interest? If you paid the interest, then yes, it would be fine. You would never lapse the policy. But if you didn't pay the interest, eventually it will explode.
But yes, money that you put in and borrowed out and never paid it back, would the policy survive? Yes.
Well, would it survive if they didn't pay the interest?
No, well, yeah, you have to pay the interest.
Yeah. Because I had a client, by the way. So Subaru John, this actually happened. Someone had another agent set up a policy who said, don't ever pay back the loans. They told the client this. The client would then borrow out the cash value for emergencies whenever they needed it, not pay it back. Then they heard us talk or me talk and called me up and said, hey, can you look at this? They had 100 and some thousand of cash value. The loan was $100,000 and it was going to implode in about 5 years. Meaning the interest was accruing so fast that it was going to supersede the cash value and that would lapse the policy. We saved their policy though, because then we showed them how infinite banking really works. They had actually $75,000 of savings of cash just sitting there for years in another account, which should have been parked in the policy to save the interest, et cetera, et cetera. But there are ways to do infinite banking and there are ways to not do it. And not doing it is not paying the interest at a minimum. So yeah, we've seen it before. But a good question though, because it does come up.
Every year your dividend payment gets higher because of the amount of your deposit. And the difference in the interest decreases year after year also. So that's part of the game.
Yeah.
The only consideration I would think that we need to add to this conversation is if you have a direct recognition company that you're working with, and that can add another element of surprise. If you're taking loans, those dividends aren't growing as if they were without the loan, so you could run into problems even faster that way. So it's all just kind of looking at where you are when you plan to pay it back. How do you plan to pay it back, and are you going to get yourself in trouble?
Craig, maybe elaborate. Let's tell the difference between a direct and a non-direct insurance.
Yeah, so there's two different ways that insurance companies handle loans and dividend crediting. So in what we call a direct recognition, when you take a loan, that loan can impact your dividend crediting. So you're not getting your full dividend is what it amounts to. Most of the companies we work with, we tend to favor non-direct recognition. And there's actually some holy wars over this. So I'm not going to get into it, but non-direct recognition, when you take a loan, the insurance company doesn't recognize that you took the loan and you get the full dividend crediting regardless. So really what it comes down to is there's some math on both sides. Some people say it doesn't matter, but it does matter if you take a loan out in a direct recognition company and you don't pay it back for a while, there will be some impacts.
Yes.
This is the whole area that actually tripped me up in the very beginning of my journey, is because it never dawned on me that there was non-direct recognition. Like Craig said, you can have an amount taken out as a loan, but it's not reduced from your cash value, so your dividends are not impacted by it. And that was the thing that tripped me up in the beginning, because I didn't, even with all my years in the insurance industry, I didn't realize that there were companies that did the non-direct recognition.
Yep. And there's some that do both.
Yeah.
As we found out.
Yeah.
So Super John had another thing saying the person is a 50-year-old male with a standard rating with Lafayette as the carrier. Not sure if that clarifies anything on the previous question.
I think that was the one asking, can you take loans, not pay them back? Is that the
correct? Yeah, correct. I don't think it did. I mean, obviously the shorter your lifespan is ahead of you, the less likely it is to lapse. The client that I was talking about where it was going to implode, they'd had the policy for 14 years or 15 years, and they were in their 40s or something. So they'd had the policy for quite some time. So time, of course, the compounding, both negative and positive, is going to come into play for sure.
Right. Yeah, and it's just a matter of how much interest is compounding. So you're reverse compounding yourself because your interest just keeps getting added to the loan and growing bigger and bigger. Eventually, that loan interest compounding could be more than your policy's growing. You've got trouble there. So, and
that's what happened to the client I had, because they had reduced the premium, so it meant that part of their dividends were going were going into some of the premium. So the value was slowing down.
Yeah.
Was that?
But you know what? If they do keep on raising and putting in that extra PUA on top of the way that it's built, there could be a little wiggle room with that.
Yeah, they'll definitely delay it. They'll definitely
It will. It'll take a little portion out a little bit as you go.
It's still not following the third principle of being an honest banker, though, Joe. Right? Like the least honest thing you can do being an honest banker still is pay this simple interest every year.
And keep putting your money to work for you to make more cash flow.
And I believe that everyone here, believes that is the way it should operate. And I think we just need to be more clear about that in the future moving forward is, look, you have to pay yourself back. If you're not paying yourself back, you're not really a good fit for our circle, our client, how we teach people, the education. I mean, it's a lifelong commitment we're making to each other by showing up, by teaching, by helping someone start a policy. So if they don't want to pay themselves back, they don't want to be honest, they're going to end up lapsing it, hurting themselves. And they're going to come back and be like, why didn't you guys tell me? So we're telling you, pay yourself back.
Yep. So Craig asked a question. What is Lafayette? Lafayette is a Lafayette insurance company.
Yeah.
So it's an insurance company.
And that is a non-direct. So they do not recognize the loan.
Yep. So I want to put this question up. I'm not quite sure what the question is here, but Algo CEO says, I have a term life policy from Gerber Life for $250K, and I want to eliminate my debt and get myself to base.
Well, I guess the first thing is it's a term policy, so there's no cash value.
Well, there could be permanent insurance. Gerber Life does have permanent.
I thought it said term.
No, it was term.
Oh, it said term. Yeah, I'll say, well, that's interesting.
I thought it
By
said
the way, who owns Gerber?
Western and Southern Financial Group. They told me that Lafayette Life.
So yeah, the same company that owns Lafayette actually owns Gerber, by the way. So there you go. But so that policy of his term insurance is not compatible for infinite banking. So if you want to get yourself out of debt, that kind of stuff, you'd have to look at an infinite banking policy if you want to use infinite banking. But the term Gerber Life policy really it doesn't have cash value. So. Bo Hunter says, would it make sense to take money from a HELOC to start a policy, take a loan and pay to the mortgage or pay to a mortgage?
Joe, this is all you. Big Joe HELOC.
Well, if we're getting a HELOC, why don't we just incorporate the mortgage into that? So yes, there are HELOCs out there that go up to 85, 89% to incorporate your mortgage to stop the amortization and put you into simple interest. Debt consolidate the car loans and all the credit cards and have it live inside the HELOC and go to simple interest. And instead of taking 26 years to pay off that mortgage, with Velocity Banking and your cash flow, you're paying it off between 3 and 6. So it definitely warrants a phone call to see how your system is being played.
Yep. So Master Cook, once again, this is the gentleman from Germany. He says, my father is 73 years old and going to have to move to the USA to get an inheritance. Well, if he's going to move to the U.S. and be U.S. citizens, then, I mean, he could potentially get a policy, but I'll just be honest, at 73, it's going to be challenging to get one that's going to make sense. You can get one, but they're not very efficient, to be honest. But it might warrant a conversation if you have some way of doing it here, but it would definitely have to be someone I would recommend potentially a bit younger. And it depends on when he's coming over here too, because at 74 or 75, you cannot do infinite banking. The policies just they can't work. So.
Yeah, he answered, or he added another one. He wrote, and if he opened an account to place it there, can he start a policy from there? I mean, yeah, it may be possible, but again, like Brian said, a policy on 73-year-old might be a challenge there.
Yeah. That being said, I am doing one right now on someone who is 73, but they're doing it for legacy purposes specifically to double the money. So, all right, Damien says, "Hey, everyone, came in for a quick check, doing my rounds, but he's on a ship and watch the replay. So yeah, he's out there deployed."
Is Damien the one that sent all the presents up to New York?
Yes, he is.
Yeah,
That's what I was thinking.
Yeah.
So thank you for your service, Damien.
Yeah, I think that's what we're doing. So Mr. Oach or Muroach says, can you use equity of a home? Yeah, so as Joe was just alluding to, we're talking about HELOCs or all-in-one HELOCs. You can use those to fund a policy or to recapture debt and do velocity banking. It has to make sense to you. It is a numbers game to understand how to use equity from a home, because you are leveraging your home. So you've got to understand, what the consequences of that can be. But yeah, I mean, that's what we help you do, is walk you through that. See, Janet says, my husband and I have a 400K term policy. Can they be switched to IBC? We are 66 and 70. Is it worth it?
Again,
I mean, it depends, but I very rarely can the term be rolled over if it was not put in place specifically for rolling it over to a whole life.
It would have to be convertible.
Yeah, it has to be convertible, and it has to be accepted by a company that does infinite banking. So the best scenario is if you have a term policy with an infinite banking focused company. And then additionally, why would you want to convert it or roll it over? The reason why is because when you roll the term to whole life, you're rolling the death benefit only over, and you don't have to qualify medically again. But you have to qualify financially though still, and you have to qualify on other things. But if you're uninsurable, perhaps that's where that conversion or convertible term comes into play. But I don't know. I mean, when's the last time anybody on here did one?
Conversion? I mean, yeah, conversions as a group, we do a number of conversions. But as far as a conversion from a different carrier to a carrier that actually supports policies for IBC, pretty rare, because in order to do that, the term policy has to be fairly new. It has to be fully underwritten, and then there's some other limits as well. So that's a pretty narrow possibility.
Yeah, for sure. All right, this one's pretty simple. Bud says, what's the cost to get started to get privatized banking?
How much money do you want to deposit into your own bank?
And I would say that's going to be driven off of what are you trying to do in terms of, let's say in 3 years you have major purchase. We want to reverse engineer and figure out how much it's going to take to build that up, or perhaps you're just trying to capitalize for something in the future. Perhaps you're trying to run as much money through the system as you can to pay down debt. So a lot of that's going to depend on your income and your cash flow and what you're doing with that now.
And to give Bud some parameters, like when I'm speaking with somebody in a strategy call, one of the things that I always talk about is, look, we don't want you to roll a gutter ball, right? So if you're taking little kids bowling, what happens? You put up the lane protectors to make sure that the ball hits the pins no matter what. And that's usually, the companies and mutually owned dividend paying companies we partner with will go up to 20 to 25% of what someone's gross income is. That's the max you can put in per year. The minimum we're telling you is just follow the first law of wealth. Pay yourself 10%. So 10 to 25%. And then like Craig said, what is your goal? What are you trying to do? How much are you saving? This is really just a matter of, are you qualified? Are you saving? Because what we find in a lot of our calls is folks just aren't saving. They're not paying themselves first. So they're really looking to become the builders, the wealth creators, and start paying themselves. And they might be at saving 3% or 4% or nothing. And they're working towards switching their habits. So if you want a good guide, 10 to 25% is where you want to be. And then when you get to the point, like some of us, where you're putting more than the 25%, that's when you're finding other insurable interest to expand your system above and beyond what you can put on your own body.
Yep. There you go. All right. Maiden Blue says, also, I was able to get an old 401k transferred to Horizon. Awesome. Horizon Trust, we know them. For self-directed, and I started lending through PMC. Awesome.
Nice. I did the same thing myself, as I transferred prior employer 401k. And then when I left the W-2 world to join this amazing crew, I rolled over to.
And then also said, just want to say thanks to the team. Happy New Year. My policy made its first birthday in December, which I'm using to pay debt off. That's awesome.
Yeah.
All right.
So then Bud had to follow up some comments here. Private coaching with one of your super smart folks. Well, I just put the our mentor link in the chat box. You can use that to schedule a call with one of us. Or if you want to talk to anybody specifically, just let us know and we can give you that link. New to this, very intrigued. Also, glad that you're here. Glad that you're learning. That's the first step right there.
Yeah.
And he wants to use the program for real estate investing. And by the way, that is probably the second main thing that people do, or they're interested in doing with infinite banking, is real estate. First is almost always debt recapture, getting rid of bad debt. Once that's done, create good debt or good cash flow. There you go. Love that. All right. So Craig says, back to the question. One, if I pay $20K per year in premium and PUA, there will still be interest owed if I borrow out the cash value. Plus, no matter what, there is a cost of insurance.
At Craig, have you read Becoming Your Own Banker by R. Nelson Nash? You know, it's right here, this book. You can go get it. It's only 91 pages. I mean, we will answer the question, but I can tell you your question is based in there's a lack of understanding of what we're trying to accomplish by privatizing your banking and what it offers you.
But and Craig, you're correct. Yes, there is going to be interest owed if you borrow the cash value. Yes, there's interest that is either you paid or it rolls back into the policy loan balance, which increases the loan balance. And then plus, no matter what, there is a cost of insurance. Yeah, and the cost of the insurance is always there, by the way. It's just that as the policy grows and the dividends compound, you don't notice it as much anymore because your dividends are so high. But, I mean, that's kind of getting into the weeds a little bit on how the policies grow. But just understand that the longer you have a policy in place, the more efficient it becomes. And the more the dividends, you'll start to see that hockey stick. And so, like, I've had someone who borrowed right away and didn't pay back right away. That's that other client I was talking about. Didn't work. But if you let the policy grow and mature and become efficient, and then down the road, like I'm talking over 10 years down the road, then you start taking capital out and don't pay it back, that actually can work. That's called tax-free retirement potentially. But you got to map that out as well. But that's where people, they want to grow it for years and then take it out down the road.
Yeah, Mr. Craig Parsons, I know you got a policy with us fairly recently. I would highly suggest getting back in touch with your money mentor to discuss this specifically and really get into the details on it and what you're thinking there. Or if you just don't really jive with him, maybe, I mean, definitely just get back on the round robin and speak with somebody differently, maybe that may understand you differently. But yeah, we can definitely get into the weeds on that.
So he's 57 and don't have time. I'm retiring in 4 weeks. Definitely hop on a call with one of the mentors or your mentor.
Yeah.
Definitely recommend that. Mr. Roach is saying, anyone particular for Michigan?
Me.
Everybody here. We're all licensed in most states, including Michigan. So yeah.
And I actually reside in Michigan.
And she's in Michigan.
Yeah.
Yeah. But yeah, we're not state specific or yeah.
That's true. We write wherever we're needed.
So
in the US.
Yep. I think we just actually made it through all the questions. I don't see any more in there right now. All right, Linus, you're going to dance or sing?
No.
Craig's one with all the guitars.
You guys laugh about that, but the last Money Tank, a full-fledged dance party did break out during one of the breaks.
Awesome.
You never know.
Craig was one of the dancers. He was tricked, but it was pretty cool.
I will have to say I was tricked.
You did, and Craig did start it. I mean, it was a little bit I saw the women swoon when he started doing full Monty. He started with a strip dance move, jacket came off, but he had a shirt underneath everyone.
That video was my highest watched video that entire month, but I kept replaying it.
I feel like I need some royalties from that one.
Yeah.
I kept throwing it back out there. That was so cool.
Some royalties and maybe some free massages or something like that. 'Cause I'm sure you probably pulled a muscle with some of the moves you were pulling out. So.
Oh yeah.
Noah pulled that one off, didn't he? It was Noah that kind of really tricked you guys.
It was Shauna. I'm putting it all on.
It was Shauna. I was sitting next to her when
Shauna came up to me and said, "You're going to be asked. They're going to ask for volunteers. You will raise your hand." And so, I had no idea it was that.
That's awesome.
I think I see a question we might have missed. Whenever you're ready.
Yeah, I'll touch on this one real quick. So Galapagos is saying, what stock should I buy? I just sold off half my TMO looking to reinvest and maybe silver or Costco. So we don't really give advice on stocks. Most of us don't really actually invest in stocks. I don't actually have anything in the stock market, I don't think, right now.
Not one penny.
Yeah, so I couldn't really, yeah.
Yeah, when it comes to stocks and any other investments, you gotta definitely you should only recommend or only invest in things you know, like, and understand.
Yeah.
Because otherwise you're taking on a lot of unnecessary risk when you don't even really understand the business or asset that you're investing in. Most of us here have been there, made the mistakes, and so that I'm speaking from experience here.
Yep.
Silver looks awesome right now, but hey, now we're at the high price, and the one of the top rules of investing from Warren Buffett is to buy low and sell high. So if you think about it like that, maybe now is not the time to buy silver, but you just don't know if we're maybe still at the bottom and we have a long ways further to go. You just don't know.
When everybody is greedy, be fearful. When everybody's fearful, be greedy.
Yes, I love that one.
Yep. All right, Bo Hunter has a question here. It says, I have a second lien HELOC, have too many acres for a first lien HELOC, started velocity banking last year and paid off $70K. Mortgage is only loan left. So that's awesome. Congrats, man.
So then you should start chunking, using the HELOC and chunking at that mortgage, and still have everything come in the one pot system with the HELOC, your paycheck, to drive that velocity down, and then just start chunking at that mortgage in order to knock it out.
Yep. Algo CEO says, I'm 40 and also wondering how much a policy would be. So
depending how much you want to deposit into your own credit union.
We answered it for someone else, but it's the same parameters we were talking about. I said 10 to 25%. You follow the first law of wealth, it's pay yourself first and at least 10%. You can go up to 20 to 25%. And it depends, like Craig pointed out, it depends on what you're trying to solve. Like, why are you starting the policy? What is your goal? What are you trying to recapture? What are you building an opportunity fund for? How much legacy are you looking to leave? There's a lot of variables. It depends on your focus. So,
yeah. And there's a range of what you can qualify on a premium per month or annual. There's everybody has their own range based upon age and income, and we review that with you on a call, because everybody always says, "Oh, what's the minimum? Oh, it's this. Oh, that's what I should put in." No, it's not. If the minimum is 10 times your age per month, 400 per month, that doesn't mean that's what you should do.
Right.
It's just the minimum. What you should do is what makes the most sense for your numbers, your goals, your finances, all that kind of stuff. So it's not something we typically give a specific number because we don't know your situation yet.
Being efficient and utilizing your money for you is the correct number.
And Joe, I remember having a conversation with you. We were looking at a client came to us from somewhere else. I don't remember what the details were behind that, but they wanted to buy a car, let's say in 2 or 3 years, 40, 50,000. They're putting in what, $200 or $300 a month. Like, well, something doesn't line up here because that's why we just harp on this. It sounds like we're harping on it, but it's just so important that if you're trying to accomplish something and we reverse engineer to figure out how much to put in, whether that works or not, then maybe it's going to take you 5 years to get that car. But those are all the things we really need to figure out in a strategy call. So,
yeah, Craig, I had one of those calls where someone came in making $500,000 a year, was 36 years old, and was like, "Hey, bye, Snaggy," and said, "Yeah, I have $300,000 in bad debt I want to pay off, and I want to use this $360 a month." I was like, "Cool. How many years is that going to take?" The answer was 70 plus.
Yeah. So it's not to beat up on people, but we just need to really put a plan together that's going to be reasonable. It's going to help you, going to help change your family, going to help change your finances. So at the end of the day, if it turns out we can't do the plan, then we figure out how close can we get and just build something from there. So
Hey Joe, go ahead.
Congratulations. That is what I'm doing.
Yep.
So we like to hear.
There you go.
Yep.
Awesome.
Any other questions, Fouts, or we get through all of them?
I think we got through all of them. Linus, did you get the one that you saw?
Fouts is muted.
You did. I Joe, I was curious about the previous question there.
Saw the
on
lips moving and nothing was happening. I think we made it through all the. Anybody else got any thoughts? Any final
Linus-
things?
Linus
we want
was
to-
talking.
Linus was talking.
Poor
Hold on.
Linus.
Whoa.
Go ahead, Linus.
Can you hear me though?
I
Yeah.
got
Yeah.
Okay. All right. So Joe, I was wondering about acreage for a first lien HELOC.
Can
Yeah.
you guys hear him?
Cross
Yeah.
one where their limit was 10 acres. Is that kind of across the board for all the banks that that do the first lien?
No. I believe first lien is up to 20. I know that CMG is a little bit more than that. I
No,
want to
CMG
say
was 10 acres.
CMG was 10.
That's what they told me.
I'm gonna check into that because I knew that there was more than first lien. So I'll get back to you on that. I'll let you know.
So, Linus, is that for commercial, residential?
Residential.
Okay, because I know they have a commercial program coming out. I think they're targeting into February for that, so that may change the details
I got you.
if it was commercial, but in this case, it's not.
How many acres do you have?
And me?
Yeah.
No, I
Versus-
was looking to buy. And so I'm thinking, okay, well, how big can I go if I
got
want to
you.
buy with a first lien?
I see.
Awesome. Well, we did make it through all the questions, I think.
Yeah. Apologies, everyone. Too. Craig, you're the only person I could hear a second ago. So I saw everyone else's mouth is moving, but there was nothing coming out of my speaker. So
Well,
I don't know.
the weird thing is, I think it was 3 weeks ago, maybe the same thing happened to me. I knew people were talking, but I couldn't hear anything. So StreamYard had some weird situation going on where I'm like,
I could hear you when you corrected me. I was like, wait, I don't see hear anybody say anything.
Yeah, I thought you guys were pulling a trick on me. I'm like, oh, they're all pulling a trick.
Oh, that's what you said. I'm out of here. I'm out of here.
It's been Craig and it's been Jason. Who will be next?
You-
I'm voting Kovacevic.
There we go.
I just
Well,
like
everybody-
saying his name.
Yeah. Cool. We made it through another Ask Me Anything, the first one of the year. So appreciate all the questions, all the kind of stuff. And with that, we'll see everybody in the next Ask Me Anything next week.
Thank
Take
you.
care.
Take care, all.
Bye-bye.